Welcome to this video on the momentum factor. After completing this section, you will be able to select stocks and factors for creating a multi-factor model, create a momentum-based factor, create a short-term reversal factor, and then combine these two factors to create a multi-factor model. While constructing a factor-based portfolio, you need to decide what stocks to use. It is a good practice to diversify your portfolio to make it more resilient to sector-specific shocks in the economy. For constructing an example of multi-factor model, we chose these stocks representing the various sectors of the U.S. economy. You can increase this list to contain any number of stocks as per your preference. In the previous section, you have learned about various factors as shown. By now you must be asking yourself, what is the basis for adding these factors in a portfolio? The answer is simple. You can add as many of these factors as you want in your portfolio. But, to gain the benefit of diversification, you need to add those factors that have a correlation coefficient very close to zero or negative. While constructing the factor model, we have used the momentum and short-term reversal factors to build a factor portfolio. As you will see in the next units, these two factors have a negative correlation, which makes them a very good fit for creating a factor-based portfolio. To create a momentum-based factor, you need to compare the current performance of the stock with its past. To do this, you can subtract the average price of the stock over the past year from the current price of the stock. Based on this difference, the factor model would either buy or sell a stock. Let us say that the current traded stock price of Amazon is $1,156 per share, and the average stock price over the past 1 year is $926 per share. Then, the difference between the two is $230. Since 230 is greater than zero, the factor model would buy the stock. The momentum factor works by buying stocks that have a positive difference, and selling stocks that have a negative difference. The assumption for this factor model is that the existing momentum will continue. So, you go with the current trend in the market. In the next video, you will learn how to create a short-term reversal factor, and then combine these two factors to create a multi-factor model.